Stop everything you're doing right now and listen to me very carefully. What I'm about to share with you happened 24 hours ago, and the implications are so severe that I need you to understand this is not speculation, this is not theory, this is documented reality that will fundamentally alter your understanding of what money actually is. At exactly 9:47 a.m. Eastern Time yesterday, Friday, January 23, 2026, silver crossed the $100 per ounce threshold for the first time in recorded human history. But here's what the mainstream financial media isn't telling you. Here's what they're deliberately hiding from you, because if the general public understood what this actually means, there would be an immediate run on every precious metals dealer in the Western Hemisphere. This is not a price spike. This is not a bubble. This is the beginning of a monetary phase transition that happens maybe once every 100 years, and you are watching it unfold in real time. I have been tracking the precious metals markets for over 2 decades, and I can tell you with absolute certainty that what occurred yesterday morning was not a normal market move. Normal markets don't gap up $5 in the first 3 minutes of trading. Normal markets don't show bid-ask spreads widening to $8 per ounce. Normal markets don't have every single major wholesaler in North America simultaneously posting sold out across their entire product line while also refusing to purchase metal from the public. That's not a market. That's a system failure. And the system that failed yesterday is the same system that has controlled the price of silver for the last 50 years, the paper derivative complex that allowed banks to create infinite synthetic supply and suppress the price of the most strategically important industrial metal on planet Earth. Let me walk you through exactly what happened, because the sequence of events matters, because each domino that fell yesterday was predicted by people who understand monetary history, and because what comes next is going to determine whether you preserve your wealth or watch it evaporate in a currency crisis that makes the 1970s look like a practice run. The Shanghai Gold Exchange opened for trading at 8 p.m. Eastern Time on Thursday night. Within the first hour of trading, silver futures contracts were hitting limit up, which means the price moved so fast that the exchange had to halt trading to prevent complete chaos. The physical settlement price in China, the actual price that refineries and manufacturers were paying for real metal that gets delivered to a vault, was $103 per ounce. Not the paper price, not the COMEX price. The price for actual silver that you can hold in your hand. By the time New York opened 7 hours later, the COMEX was in full panic mode. The gap between the paper price in New York and the physical price in Shanghai was $8 per ounce, the widest spread in the history of modern precious metals trading. This is the arbitrage opportunity of a lifetime, right? You should be able to buy silver on the COMEX for $95 and sell it in Shanghai for 103s and pocket an instant $8 profit per ounce. Except you can't. And here's where it gets wild. You can't execute that arbitrage because there is no physical silver available for delivery on the COMEX. The entire exchange is a paper fiction. It's a casino where people bet on the price of silver using contracts that reference silver that doesn't exist, has never existed, and will never exist. And yesterday morning, the world figured that out. The first sign of systemic stress came from the wholesalers. These are not small operations. We're talking about companies that move hundreds of millions of dollars worth of precious metals every single month. Companies like APMEX, JM Bullion, SD Bullion, the backbone of the North American physical silver market. At 10:15 a.m. Eastern, their websites started going dark, not crashed, not overloaded, deliberately taken offline. By 11 a.m., every major dealer had posted the same message. All products sold out, no estimated restock date, we are not accepting sell orders at this time. Read that again. Not accepting sell orders. They don't want your silver. They will not buy it from you. How is that possible when the price just hit an all-time high and demand is exploding? I'm going to tell you exactly why, and this is where the story gets truly disturbing, because what happened to these wholesalers is the same thing that happened to long-term capital management in 1998, the same thing that happened to Bear Stearns in 2008, the same thing that always happens when highly leveraged financial entities bet against a monetary asset during a currency crisis. They got liquidated by their own hedging strategy. Stay with me here, because understanding this mechanism is critical to understanding why the price of silver is about to go parabolic and why the paper market is in the process of complete disintegration. Every single bullion dealer in North America operates under the same business model that was forced on them by the commercial banks that provide their credit lines. When a wholesaler purchases 1,000 ounces of physical silver to put on their shelf, their lender, typically a major commercial bank like JP Morgan or Bank of America, requires them to immediately hedge that position by selling 1,000 ounces of paper silver on the COMEX futures exchange. This is called being delta neutral. The theory is elegant. If the price of silver goes down, your physical inventory loses value, but your short position on the futures exchange makes money, and the two cancel each other out. You're protected from price volatility. You make your profit on the spread, the difference between what you paid and what you sell it for, and you sleep well at night knowing you're not exposed to price risk. But here's the fatal flaw that nobody talks about. Here's the trap that just destroyed the entire wholesale infrastructure. When the price of silver goes up, especially when it goes vertical like it did yesterday, your short position on the COMEX starts bleeding cash at an exponential rate. Every single day, the exchange calculates your losses and sends you a margin call, a demand for immediate payment in cash to cover those losses. This is called variation margin, and it is due within hours, not days or weeks. You cannot negotiate with it. You cannot delay it. You either wire the money to the clearinghouse or your position gets liquidated and you're out of business. So picture this scenario. Silver goes from $75 on Monday to $100 on Friday. That's a $25 move in 5 trading days. If you're a wholesaler with 10 million ounces of physical silver in inventory, which is not unusual for a large operation, and you're short 10 million ounces on the COMEX to hedge that inventory, you just lost $250 million on paper. Where does that $250 million come from? It comes from your operating capital. It comes from your credit line. It comes from liquidating every liquid asset you have. And when you run out of liquid assets, which happened to multiple dealers yesterday, the bank pulls your credit line and you go into emergency shutdown mode. This explains the sold out but not buying paradox that makes no sense to anyone who doesn't understand derivatives. The dealers have plenty of silver. They're sitting on warehouses full of it, but they cannot access the cash value of that silver because all of their liquidity has been drained by margin calls on a futures position that was supposed to protect them. They are asset rich and cash poor, which in the financial world is just another way of saying bankrupt. The physical silver in their vault is worth $100 per ounce, but they can't sell it fast enough to cover the daily margin calls from the COMEX, so they're stuck in a death spiral where rising prices are actually destroying their business. And here's the part that should terrify you if you understand systemic risk. The commercial banks that lent money to these wholesalers are the same banks that are short the silver market at the institutional level. Bank of America, according to the latest Office of the Comptroller of the Currency report, has a derivatives book with exposure to precious metals in excess of $30 billion notional value. JP Morgan, the largest player in the space, has been fined multiple times for manipulating the silver market through spoofing and layering on the futures exchanges. These banks have a vested interest in seeing the physical supply chain collapse, because if the physical market breaks away from the paper market, if the Shanghai premium becomes permanent, the entire derivatives complex implodes, and those banks are sitting on losses that could exceed their total capital reserves. So what did the banks do yesterday when silver hit $100? They cut the credit lines. Every major wholesaler in North America received phone calls from their lenders informing them that their revolving credit facilities were being reduced or terminated effective immediately. Not because the wholesalers were insolvent, not because they missed payments, but because the bank's risk models flagged silver as too volatile to finance. This is the credit freeze, and it's the same playbook that was used in 2008 to destroy Lehman Brothers. You don't need to bankrupt someone directly. You just cut off their access to liquidity and let the market do the rest. The consequences of this credit freeze are catastrophic for anyone trying to buy or sell physical silver through traditional channels. Your local coin shop, the guy on Main Street who's been serving the community for 30 years, operates on cash flow. He buys silver from the public in the morning, calls his wholesaler to sell it in the afternoon, and uses that cash to buy more silver the next day. It's a pass-through model. But yesterday, when he called his wholesaler to sell the silver he just purchased from a customer, the wholesaler said, "We're not buying." No bid. The local dealer is now stuck holding inventory that he cannot flip, which means he's out of cash, which means he cannot buy more silver from the public, which means he has to shut down operations until this crisis resolves. Multiply this scenario across 10,000 independent dealers in North America, and you start to understand the scope of the supply chain failure. The infrastructure that moved physical silver from refiners to consumers for half a century just stopped functioning. Not because there's no demand, the demand is higher than it's ever been, but because the financial mechanism that facilitated those transactions has been deliberately sabotaged by the same banks that are short the market. This is not a free market failure. This is economic warfare being waged by the paper gold cartel against the physical metal holders, and yesterday the physical holders won the first major battle. Let me show you the evidence because I don't expect you to take my word for any of this. I have in front of me a trade sheet from one of the largest bullion distributors in the United States, a company that does over $500 million in annual revenue. This document was sent to dealers at 2 p.m. yesterday, and it shows their bid and ask prices for every major silver product. On the sell side, every single line item says sold out. American Silver Eagles sold out, Canadian Maples sold out, 100-ounce bars sold out. This is expected. We know there's a shortage, but look at the buy side, the prices they're willing to pay if you want to sell silver to them. Multiple products are listed as no bid. That means if you call them with 1,000 ounces of silver, they will not make you an offer. They do not want it at any price. How can this be possible when silver just hit $100 per ounce and retail demand is up 400% year over year? How can a silver dealer not want to buy silver? The answer is they want it, but they physically cannot purchase it because their credit line has been cut and all their available cash is being sent to the COMEX to cover margin calls on a short position that is bleeding them to death. They are trapped in a liquidation cycle, and the only way out is to either raise massive amounts of new capital, which is impossible in the current environment, or declare bankruptcy and walk away. We are going to see a wave of dealer bankruptcies in the next 30 to 60 days. Mark my words. Companies that have been operating since the 1970s are going to close their doors permanently because they cannot survive the volatility that the paper market created. But let me bring this back to you, to the individual watching this right now who owns physical silver or is thinking about buying it. What does this mean for your stack? What does this mean for your wealth? The answer depends entirely on whether you own unencumbered physical metal or whether you own paper proxies. If you own physical silver that is in your possession, in your safe, in your vault, with no debt against it and no counterparty risk, you are now holding one of the most valuable assets on planet Earth, and its value is only going to increase as this crisis deepens. But if you own silver through an ETF like SLV or through a futures contract or through allocated storage at a bank, you are about to learn a very expensive lesson about the difference between owning an asset and owning a claim on an asset. The silver market just bifurcated into two separate markets that will never converge again. There is the paper market, the COMEX, the futures exchanges, the ETFs, where the price is set by algorithms and leveraged speculators and central bank intervention. And then there is the physical market, the real market, where actual metal changes hands, and the price is determined by supply and demand in the physical world. Yesterday, the paper price closed at $98.50 per ounce. But the street price, the price that private buyers are actually paying for physical metal in over-the-counter transactions, is $130 per ounce. That's a $30.50 premium over the paper price, the widest premium in history, and it's only going to get wider. Why is the street price so much higher than the paper price? Because the street price reflects reality. It reflects the fact that there is almost no physical silver available for purchase at any price. It reflects the fact that the wholesale distribution network has collapsed. It reflects the fact that industrial users like Samsung and Tesla are competing directly with retail investors for the same finite supply of metal. And most importantly, it reflects the fact that smart money, the people who understand monetary history, are willing to pay whatever it takes to get their hands on real silver before the paper market completely disintegrates and takes the dollar with it. Let me talk about the geopolitical dimension of this crisis, because what's happening in the silver market is not happening in isolation. This is part of a coordinated attack on the US dollar's status as the global reserve currency, and silver is the weapon being used to expose the fraud at the heart of the Western financial system. China has been accumulating physical gold and silver for over a decade in preparation for this exact moment. The Shanghai Gold Exchange, which is controlled by the People's Bank of China, now sets the global price for physical precious metals. Not London, not New York, Shanghai. This represents a fundamental shift in monetary power from west to east, and the United States is losing that war. The Russian central bank announced 2 weeks ago that it would no longer accept dollars for energy payments from unfriendly nations. Saudi Arabia, America's most important petrodollar partner for the last 50 years, just signed a currency swap agreement with China that allows them to settle oil transactions in yuan. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the 40 other countries that have applied to join the bloc, are in the final stages of launching a commodity-backed trade settlement system that will bypass the dollar entirely. And at the center of this new system is gold and silver, the only forms of money that have maintained their value for 5,000 years of human history. What you're witnessing right now is not just a silver shortage. It's the end of the post-1971 fiat currency experiment. When Nixon closed the gold window in 1971 and severed the dollar's link to precious metals, he unleashed 55 years of monetary expansion that has debased the currency by over 98%. A dollar in 1971 could buy what it takes $8.25 to buy today, but the debasement is accelerating. In the last 4 years alone, the Federal Reserve has printed more dollars than existed in the entire money supply before 2020. This is not sustainable. This is not normal. This is the end game of every fiat currency in history, and silver is the canary in the coal mine that's telling you the mine is about to collapse. The United States government is now running a $2 trillion annual budget deficit with no plan to reduce it. The national debt just crossed $36 trillion and is growing by $1 trillion every 100 days. The interest payments on that debt now exceed the entire defense budget. We are in a debt spiral that can only end in one of two ways, either default or hyperinflation. The government will never choose default because that would mean admitting insolvency. So they will choose inflation. They will print whatever amount of money is necessary to service the debt, and in doing so, they will destroy the purchasing power of every dollar in existence. This is why silver is going to $200 per ounce, and this is why $200 is just the beginning. When a currency collapses, hard assets revalue to reflect the new reality. In Weimar Germany in 1923, an ounce of gold went from 100 marks to 87 trillion marks in the span of 2 years. In Zimbabwe in 2008, an ounce of gold went from 50,000 Zimbabwe dollars to 500 trillion Zimbabwe dollars in 18 months. These are not theoretical examples. This is what happens when a government loses control of its currency, and the United States is on the same trajectory. The difference between what happened in Germany and Zimbabwe and what's happening now in the United States is that the dollar is the global reserve currency. 70% of all international trade is still denominated in dollars. 60% of all central bank reserves are held in dollars. When the dollar collapses, it doesn't just affect Americans. It affects every person on earth who holds dollars or dollar-denominated assets. This is why countries are scrambling to exit the dollar system. This is why central banks bought a record 1 to 100 tons of gold last year. This is why silver demand from sovereign entities has increased by 300% in the last 24 months. They know what's coming. And here's what you need to understand about the next phase of this crisis. The paper market suppression scheme only works as long as people believe that paper silver is equivalent to physical silver. The moment that illusion breaks, the moment that holders of SLV shares or COMEX futures contracts demand physical delivery and are told that delivery is not available, the entire system vaporizes. We are approaching that moment. Yesterday's price action was a warning shot. The next move will be the break. I want to address something directly because I know there are people watching this who are skeptical, who think this sounds too extreme, who believe that the system is too big to fail and that someone will step in to fix it before it gets truly catastrophic. Let me be very clear with you. The system is designed to fail. It was always designed to fail. The people running the system, the central bankers, the treasury secretaries, the heads of the major commercial banks, they know it's going to fail. They've known for years. Their job is not to prevent the collapse. Their job is to manage the collapse in a way that preserves their power and transfers the losses to you. This is why they're pushing central bank digital currencies. This is why they're talking about banning cash. This is why they're implementing capital controls and wealth taxes and negative interest rates. They are building the infrastructure for a controlled demolition of the current monetary system and the implementation of a new system where they have total surveillance and total control over every transaction you make. Physical gold and silver are the only assets that exist outside of that control grid. You cannot freeze someone's gold. You cannot seize someone's silver with the click of a button. This is why they have spent 50 years suppressing the price and convincing the public that precious metals are barbarous relics that have no place in a modern portfolio. But the suppression is ending because the physical supply is running out. You cannot print silver. You cannot create it with a keystroke. The annual mine supply is approximately 800 million ounces, and annual demand is now over 1.2 billion ounces. That's a 400 million ounce deficit that has to come from somewhere. For years, it came from above-ground stockpiles, from central bank vaults, from secondary recycling. But those stockpiles are now depleted. The vaults are empty. The refiners are running at maximum capacity and still cannot meet demand. This is a structural deficit that cannot be solved with higher prices because most of the demand is inelastic. Samsung needs silver to make solar panels. Tesla needs silver for electric vehicle components. The military needs silver for missile guidance systems. These buyers will pay whatever price is necessary because there is no substitute for silver in these applications. So when I tell you that silver is going to $200, I'm not giving you a price target based on technical analysis or chart patterns. I'm giving you a mathematical inevitability based on supply and demand fundamentals. If demand is 1.2 billion ounces and supply is 800 million ounces, the price has to rise until demand is destroyed or new supply is created. At $100 per ounce, we are nowhere near demand destruction. In fact, demand is accelerating. Retail purchases in January 2026 are running at 5 times the level of January 2025. Industrial demand is at an all-time high because of the green energy transition and the AI boom, both of which require massive amounts of silver. The only way to bring supply and demand back into balance is for the price to rise to a level that makes previously uneconomic mining projects profitable and incentivizes massive recycling efforts. Based on current production costs and the depletion of easy-to-access silver deposits, that equilibrium price is somewhere between $150 and $300 per ounce. And that's assuming the dollar maintains its current value, which it won't. If the dollar continues to debase at the current rate, the nominal price of silver could go much, much higher. Let me give you a framework for thinking about what's coming in the next 12 months, because I want you to be prepared mentally and financially for the volatility that is about to hit this market. We are in phase one of a four-phase transition. Phase one is the physical shortage and the breakdown of the wholesale distribution network. This is where we are right now. Dealers cannot get inventory. Premiums are exploding. The paper price and the physical price are diverging. This phase lasts until the paper market breaks completely. Phase 2 is the COMEX default. At some point in the next 3 to 6 months, a large institutional buyer is going to stand for delivery on a futures contract, and the exchange is going to fail to deliver the metal. This has never happened in the 50-year history of the COMEX, but it is inevitable given the current supply situation. When this happens, the entire world will realize that the paper market is a fraud, that the price has been manipulated for decades, and that physical metal is worth far more than the screen price suggests. The paper price will collapse, and the physical price will explode in opposite directions. Phase 3 is the sovereign scramble. When the COMEX defaults, central banks and sovereign wealth funds are going to panic. They will attempt to acquire physical gold and silver at any price to shore up their reserves before the dollar loses reserve currency status. This is when you will see $200, $300, $500 silver. This is when shortages become total. You will not be able to buy silver at any price because there will be none available to the retail market. Governments will nationalize mines, they will implement export bans, they will confiscate private stockpiles if they can. This is the chaos phase, and it could last anywhere from 6 months to 2 years, depending on how quickly the new monetary system is implemented. Phase 4 is the reset. The IMF, the Bank for International Settlements, and the major central banks will announce a new global monetary framework. It will likely involve some form of commodity backing, probably a basket of gold, silver, oil, and other strategic resources. The dollar will be devalued against this basket by 60 to 80%. Your savings, your retirement accounts, your bonds, anything denominated in dollars, will lose the majority of its purchasing power overnight. But if you own physical gold and silver, your wealth will increase in proportion to the devaluation. This is not a prediction. This is the historical pattern that has played out in every major currency crisis for the last 500 years. Now, I need to talk about the practical implications of this for your personal situation, because understanding the macro picture is useless if you don't know how to protect yourself and your family. If you own physical silver right now, do not sell it. I don't care if the paper price goes to $150 and you see a massive unrealized gain. Do not sell your metal to a dealer for dollars. The dollars are becoming worthless. The metal is becoming money. You are trading real wealth for fake currency. The only time you should consider selling silver is if you need to exchange it for another hard asset, real estate, productive farmland, tools, equipment, or if you need to use it to purchase essential goods and services in a barter economy. If you do not own physical silver yet and you're thinking about buying, you need to act immediately, but you need to be smart about it. Do not buy paper silver. Do not buy SLV. Do not buy futures contracts. Do not buy allocated storage programs where the metal is held by a bank. You need to own the actual metal, and it needs to be in your physical possession. The problem is that finding physical silver at a reasonable price is now almost impossible. The major online dealers are sold out. The local coin shops that are still operating are charging $130 to $150 per ounce, which is a 30 to 50% premium over the paper price. So what do? You go peer-to-peer. You find private sellers. You join local precious metals groups. You network with other stackers. You offer cash, and you be prepared to pay the street price, which is currently around $130 for generic rounds and $140 for government-issued coins. Yes, this is expensive compared to what silver was trading at 6 months ago, but 6 months ago, the system was still functioning. 6 months ago, you could buy from dealers at reasonable premiums. That world no longer exists. The new reality is that physical silver has a premium because physical silver is scarce and scarce things are valuable. I also want to address the people who are thinking about buying large quantities, talking about 10,000 ounces or more. If you are in a position to make a purchase of that size, you need to understand that you are now operating in a completely different market. You cannot call a wholesaler and place an order. They don't have inventory and they won't extend credit to new customers. Your only option is to go direct to refiners or to source metal from private liquidations. This means building relationships, traveling to meet sellers in person, arranging for secure transportation and storage. It is a level of complexity that most retail investors are not prepared for, but it is the new normal in a market where the traditional distribution channels have failed. And let me address the security issue because this is critical. If you own a significant amount of precious metals, you are now a target, not just from criminals, but potentially from your own government. We have historical precedent for this. In 1933, Franklin Roosevelt signed Executive Order 6102, which made it illegal for American citizens to own gold. The government forced everyone to turn in their gold coins and bars at a fixed price of $20.67 per ounce. and then immediately revalued gold to $35 per ounce, effectively confiscating 40% of the wealth of every gold holder in the country. Could this happen again? Absolutely. In fact, I would argue it's likely once we reach the sovereign scramble phase. This is why you need to think very carefully about how you store your metal. Do not keep it all in one location. Do not tell people you own it. Do not post about it on social media. Diversify your storage across multiple secure locations, some at home, some in private vaults, some in jurisdictions outside the United States if possible. Consider allocating a portion of your stack to easily concealable forms like junk silver coins or small bars that can be moved quickly if necessary. And for the love of God, do not store your precious metals in a bank safety deposit box. The bank is not your friend. The bank is an agent of the government, and when the government wants your metal, the bank will hand it over without hesitation. Now let me address the elephant in the room. A lot of people watching this are thinking, okay, I understand that silver is valuable. I understand the system is breaking down, but what am I supposed to do with my silver if the dealers won't buy it? How do I convert it back to currency if I need to pay my mortgage or buy groceries? This is the right question to ask, and the answer is that you're thinking about it wrong. You don't convert silver back to currency. Silver becomes the currency. We are entering a period of monetary transition where the primary medium of exchange shifts from paper fiat issued by a bankrupt government to hard assets that hold value across time and space. This has happened hundreds of times throughout history. The Romans used silver coins, the British used gold sovereigns, the American colonists used Spanish silver dollars. For thousands of years, precious metals were money, and paper was just a receipt for metal held in a vault. We are returning to that system, not because people want to, but because the alternative, a purely fiat system backed by nothing but government promises, has failed. So how do you use silver as money in a practical sense? You barter. You trade directly with people who need what you have and have what you need. Let me give you an example. Let's say you need to buy food, and the grocery store is still accepting dollars, but the price of food has doubled because of inflation. You could sell some of your silver to a dealer for dollars and then use those dollars to buy food, but you're getting destroyed on both ends of that transaction. The dealer is paying you $90 for silver that's worth $130 on the street, and then the grocery store is charging you inflated prices in a debasing currency. Instead, you find a farmer or a rancher who produces food and you offer to trade him silver directly. You give him 1 ounce of silver, which has intrinsic value and will hold its purchasing power, and he gives you $130 worth of food at current prices. No middleman, no bank, no taxes, no paper trail. This is peer-to-peer commerce, and it is the future. This same model applies to every other essential good and service. You need car repairs, trade the mechanic silver. You need medical care, trade the doctor silver. You need housing, trade the landlord silver. The key is building a network of people in your local community who understand that the paper system is collapsing and who are willing to transact in real money. This network becomes your lifeline when the banks close, when the credit cards stop working, when the ATMs run out of cash. And that moment is coming faster than most people realize. I want to circle back to something I mentioned earlier about the geopolitical situation because it's important to understand that what's happening with silver is not just an economic event, it's a strategic event with massive implications for global power structures. The United States has maintained its position as the dominant superpower for the last 80 years. Primarily through control of the global reserve currency. This allowed America to export its inflation to the rest of the world, to run unlimited deficits without consequences, and to sanction any country that didn't comply with U.S. policy. But that power is predicated on the world's willingness to accept dollars as payment for real goods and services. When countries stop accepting dollars, when they demand payment in hard assets or alternative currencies, the entire American empire begins to crumble. This is why the U.S. has fought wars in Iraq, Libya, and Syria, not because of weapons of mass destruction or humanitarian concerns, but because those countries threatened to sell oil in currencies other than dollars. The petrodollar system is the foundation of American power, and it is collapsing right now in real time. Saudi Arabia's decision to allow oil sales in yuan, Russia's insistence on gold or commodity-backed payments, China's launch of the petro-yuan futures contract, these are all deliberate attacks on dollar hegemony, and they're working. Global dollar reserves have fallen from 70% of total central bank holdings to just 58% in the last 5 years. That decline is accelerating, and as the dollar loses its reserve status, the United States loses its ability to print money without consequence. This is why the silver market matters. Silver is the people's money. Gold is for central banks and billionaires. Silver is affordable enough that ordinary people can accumulate it, but valuable enough that it represents real wealth. If the global population starts hoarding silver as a store of value and a medium of exchange, it creates a parallel monetary system that exists outside of government control. This terrifies the powers that be because they cannot manipulate a system based on physical metal the way they can manipulate a system based on digital fiat. The war for monetary supremacy is being fought on multiple fronts. There's the military front, which we see in Ukraine and the Middle East. There's the economic front, which we see in tariffs and sanctions. And there's the monetary front, which we see in the gold and silver markets. The outcome of this war will determine what the world looks like for the next 100 years. Will we have a multipolar world where different regions use different currencies and commodity-backed money is the standard? Or will we have a unipolar world where a single digital currency controlled by supranational institutions like the IMF is forced on everyone through social credit systems and capital controls? I know which future I'm betting on, and that's why I'm holding silver. Because no matter which scenario plays out, precious metals will have value. If we get the multipolar commodity-backed future, silver is money. If we get the dystopian digital control grid future, silver is the off-ramp, the asset you can use to preserve wealth outside the system. Either way, owning silver is the right move. Let me give you the final piece of the puzzle, the piece that connects everything we've talked about and makes the path forward crystal clear. The reason the silver price is going to $200 and beyond is not just because of supply and demand fundamentals, although those are important. It's not just because of currency debasement, although that's accelerating. The real reason is psychological. It's the moment when the collective consciousness shifts from viewing silver as a commodity to viewing silver as money. That shift is happening right now. 5 years ago, if you told someone you were buying silver, they would look at you like you were crazy. Today, everyone knows someone who owns silver. The conversation has changed. People are waking up to the fact that their dollars are losing value, that their government is lying to them about inflation, that the stock market is a rigged casino, and that they need to protect themselves. Silver is the easiest, most accessible way for ordinary people to opt out of the system. When this psychological shift reaches critical mass, when 10% of the population decides they want to own silver, the available supply will be absorbed in a matter of weeks. There are 8 billion people on Earth and only 2 billion ounces of silver in above-ground investable form. That's 1/4 of an ounce per person. If just 1% of the global population tries to buy 10 ounces each, that's 800 million ounces of demand against a supply that doesn't exist. The price would have to rise to a level that most people today would consider absurd just to ration the available supply among competing buyers. This is the scenario we are heading into, and it's why I'm telling you to hold your silver no matter what happens to the paper price. Do not let short-term volatility shake you out of your position. Do not sell because the price drops 20% in a week. Do not sell because some talking head on television tells you the bubble has popped. This is not a bubble. This is a revaluation. Bubbles are driven by speculation and leverage. This is driven by fundamentals and the failure of the current monetary system. Your silver is your insurance policy against everything that can go wrong. It's insurance against inflation, against currency collapse, against bank failures, against government confiscation of digital assets. It's the one asset that has maintained its value for 5,000 years of human history through the fall of empires, through wars, through plagues, through every crisis imaginable. Silver has survived and retained its purchasing power. The same cannot be said for any fiat currency ever created. So hold your silver. Add to your stack when you can. Build your network of like-minded people who understand what's coming. Prepare for a world where the old system no longer functions and new systems have to be built from the ground up. And most importantly, share this information with people you care about, because the mainstream media will not tell them the truth. The financial advisors will not tell them the truth. Their government will certainly not tell them the truth. It's up to us, the people who have done the research and understand monetary history, to sound the alarm while there's still time. The silver market just broke. The price hit $100 yesterday for the first time in history. The next stop is $200. The wholesale distribution system has collapsed. The paper market is in its death throes. The geopolitical realignment is accelerating. And through all of this chaos, one truth remains constant. Physical silver held in your possession is wealth. Everything else is just a claim on wealth, and claims can be defaulted on. The middleman is dead, the system is failing, but if you hold the metal, you hold the power. Keep stacking.